welcome you to our webcast this afternoon, How to Buy a Business Without Losing Your Shirt. This is part of our Navigate Acquisition Series. And this is also what we call a Webit, cool content fast, in 30 minutes and on your way, except for the Q&A. Our cool Webit mascot is a copyright of Navigate. Some general information before we start here. All attendees are in listen-only mode. If you would like to ask a question at any time during the webcast, please feel free to do so. There is a Q&A window on the right side of your screen. Be sure to click the send button to submit your question to us. We will open the session for discussion at the end of the event. You can also click to raise your hand, and we have Linda Smith, our business manager, who's monitoring the Q&A throughout the event, so she'll watch you and she can communicate with you through the chat panel as necessary. The raised hand indicator is removed if you want to click on that to remove it as well. We are recording today's webcast. Your participation in the event represents your acknowledgement of the recording and your agreement to participate. With that, let's introduce ourselves. Boaz, I've opened your microphone up. If you'd like to do me a favor and give me a quick introduction.
Carl Buell is the founder of Navigate and is a Fortune 50 executive with over 30 years of management and entrepreneurship. Carl bought and sold some of his own businesses, as well as played as a advertising executive in General Mills, Pillsbury, to accounts like McDonald's. Was a former Microsoft executive that dealt a lot with business development and government affairs, and then moved on to start Navigate.
Great. And you just heard Boaz Vinogradov. Boaz is a former president and CEO of several technology and medical device companies. He's grown companies from startups from 30 million to 100 million in sales, and has participated in taking companies public with initial public offerings on the NASDAQ and Swiss Stock Exchange. So with that, what we'd like to do is just give you a brief pitch about Navigate, a brief sponsorship announcement. Our company is Navigate. It's a combination of navigation and advocate. We provide business sales and acquisition services for privately held, entrepreneurial-owned emerging companies with revenues up to about $25 million. We focus on the underserved market segment above business brokers and below the investment banks. We represent sellers, buyers, and owners who also want to grow their companies through private equity relationships, and we're speaking to private equity firms on a daily basis. Comments today reflect the opinion of management, but do not necessarily represent official recommendations for you or your clients. Please consult an attorney or CPA before making any decisions. Your mileage may vary. Let's talk about the agenda. We're going to talk about the biggest mistake made by over 90% of first-time buyers, not just actually first-time buyers, but many buyers make this mistake. We're going to talk about creating an advisory team and how important that is in making these decisions and going through a business acquisition process. We'll talk about budgeting for an acquisition and how today's market psychology can really work against you as a buyer. We'll also talk a little bit about reducing risk. So those are the topics. Let's get into it. The biggest mistake that entrepreneurs make. So that is a question. What is the biggest mistake made by most buyers? And this is a mistake not made by corporate acquisition teams. In order to ask this question, we're actually going to do a survey. And so, Linda, I have unmuted you here. If you would like to start the survey, I think it's time for 1 minute. It's simply one question.
Okay, the question is, what is the biggest mistake made by most buyers?
Okay, so we've got some questions Some answers are saying one of the biggest reasons is not having enough experience to actually make the acquisition. Some other people have said not having enough advisors to help you through it. We've got someone who said we've got not enough budget to get through the process. Let us share with you our reason for what we think the biggest mistake is, and that's failure to take a planning-based approach. Well, let's look at the two approaches: a corporate acquisition versus an entrepreneurial acquisition. On the corporate side, the way a corporation approaches an acquisition, they're going to define their goals. Is it cost reduction? Is it new customer access? Is it new markets? Getting new distribution channels, proprietary technology acquisition, expanding production capacity. And they do identify those specific goals as they approach an acquisition. They also define what their schedule is going to be. When are we going to start? What's the negotiation phase going to look like? What's the due diligence phase going to look like? Closing, integration phase. Then they're going to look at their resources and determine what people are available to help with the acquisition. They're going to have someone looking at tax strategy. They're going to have someone developing a search plan for those goals. We'll have someone on the corporate side thinking about who's on the negotiation strategy team, what does the deal strategy and structure look like, how do we approach due diligence, and then finally, most importantly, what's our integration strategy. So that's how large corporations take a look at it. On the entrepreneurial side, often what we see is a very different approach, which is I'm just going to talk to as many brokers as possible, and I'll know it when I see it. And quite frankly, that's the extent to which we see planning on the entrepreneurial side with most entrepreneurs when they do an acquisition. Obviously, the planned approach gives you planned results, and a random approach gives you random results. So a key part of approaching an acquisition as an entrepreneur is really to get organized and take a planning approach. And that really starts with developing a business plan. The company needs a plan like a ship needs a course. The ship cannot see its final destination, obviously, for 99% of the voyage. But your plan needs to start with a vision and a mission. The vision outlines what the organization wants to be. Microsoft's vision is and has been a computer on every desk. The mission is the purpose of the organization. Again, Microsoft's purpose is with a computer on every desk, they want it running Microsoft software. Some companies will talk about values, which is a common belief system that the organization shares. And what we know from management and running companies is that every organization tends to pattern off the mother hen. So whatever behaviors are acceptable up at the top are the behaviors that multiply throughout the organization. We also think as part of the business plan, you should SWOT yourself. What that means is looking at strengths, weaknesses, opportunities, threats, to define what you're good at and what your strengths are and what your weaknesses are before you go into an acquisition. Stakeholders include defining who's going to be involved in this decision-making process. Your spouse and family or significant other are going to be at the top of the list. You may have shareholders, obviously customers, employees, suppliers, creditors, regulators, communities. Then you want to take a look at business strategy, which includes your corporate strategy, your cross-business unit strategy, the direction of your company operating strategy, operating units, products, services, business models, financial management, customer need fulfillment. And then on the execution side, you need to define what your tactics are for how you're going to execute your plan. And then the last element is controls, which includes measurement systems and tracking systems. So part of your business plan, if you're going into an acquisition, is you want to also create a very specific acquisition plan. And yes, it probably needs to be written, but it doesn't need to be as detailed as a Fortune 500 company might write, but it does need to be aligned with your goals and your personal resources and your requirements, or that of your company if this is a corporation that's doing the acquisition. The document isn't as beneficial, I think, as the process. The document enables the communication. It could simply be an outline, but it needs to include purpose and goals of the acquisition. What's the schedule? What are our resources going to be for the acquisition? You need to take a look at tax strategy, what your search plan is going to look like, what your deal strategy is going to look like, and who's going to be involved in negotiations, and what that strategy is going to look like when you get to that point. Defining acquisition criteria is a very important part of the plan, because you want to, when you look at business type, not all businesses obviously are equal. Are you buying a service business, a manufacturing company? Are you getting into distribution, technology, healthcare? So you need to think about it up front. The business model talks about what kind of revenue model is going to be used for the company that you acquire. Is it going to be a business to business? Is it going to be business to consumer, an e-commerce type of company, an online company? These are important things to figure out in advance. You want to look at the stage of the company that you are evaluating for an acquisition. Are you looking for a mature company, a steady state, growing, a startup? What is your appetite for different types of business stages? Some companies obviously want to get in early while the value may be low, but there's higher risk involved. And most companies doing an acquisition want to buy a revenue stable company that has a solid customer base and a long history of producing revenue and profitability. So on the revenue side, you're going to be looking at, are we doing recurring revenue, or is this going to be a transaction-based model? Is it going to be an online model? Again, these are all things to look at and consider up front, and of course you want to take a look at geography as well. Are you looking in a city, a market, a region, a state, or nationally? These are all important things to define. You also want to take a look at your financial criteria. Part of that is the revenue size of the company. We're going to acquire a company that's $2 to $5 million in revenue, $5 to $10 million in revenue. You need to be specific about what you're looking at, because certainly affordability is a part of that. You can't really define revenue without looking at what's the gross margin going to be. This is related obviously to the business model in terms of the profitability. What kind of EBITDA is this company going to produce that we're going to target? You have to look at working capital. This is something that buyers often don't budget for and is very, very important to do when you get into an acquisition. There are a lot of expenses that start out right away, and you need to be prepared for those financially. Then also you need to look at what's the maximum purchase price. So as you define your financial criteria in advance, when the opportunity comes along, then you know you'll have a criteria set from which to make those evaluations. Another important part of it is to, after you've defined a plan, is to think about creating a team and think about all those different areas of expertise where you are going to need help. Think about all of the phases of your plan and the interconnectivity of all of those different phases, and then think through who, either internally and externally, you need to have involved in order to help you make this decision. Whether your matrix looks like this or not isn't really important. What's important is that you decide who is going to be involved, why you want them involved, what the roles and responsibilities are, and what the interconnectivity is between the different decisions that you need to evaluate and make. Your tax advisor is obviously focused on taxes. Your attorney is focused on specialized areas of the law. Your business advisors know how to build a business. Your insurance advisor can help mitigate risk. We also suggest that you involve an intermediary in the process, because a business intermediary is involved in this type of work every day long. And day in and day out, they are exposed to the patterns of what happens in the industry. And as a result of that, they can make a significant contribution in an area where the others can have input but don't really have day-to-day involvement or experience. Clearly, none of these people will work for free, so that is part of the budgeting process as you think about building your team and creating your team. So that gets to budgeting for an acquisition. We have several phases that you need to think about in terms of budgeting. One is the planning phase. We just talked about all of the advisors and how you need to budget for your legal representation, your CPA's involvement, how much time is that going to cost for you to have them involved? Where do you need them involved? Where do you not need them involved? The budgeting phase for advisors is linked to that planning phase. We've got a search phase where if you're going out to search for a company, there are related communications costs for reaching out and finding those companies, targeting those companies. In the negotiation stage, you're going to have advisors advising you with negotiation. Everything has a cost. Obviously, structuring the deal with your advisors is going to have a cost. And when you get into the due diligence phase, you will have, again, advisors involved. There may be research reports that you're going to be buying. You may be traveling. So these are all things to think about and budget for. Closing costs, obviously, represent a significant part of the process. The closing costs will be estimated by the closing agent in advance. There's no way really to understand how much that's going to be, and it depends on whether or not there's real estate involved, leases of property, leases of equipment, etc. So all of those things obviously add up. And then you've got the integration and transfer cost. As we say in our white paper that we have recently done on the acquisition process, you can't look at the closing as the end of the process. You have to look at it as the beginning of the process, and there are always costs involved in that integration phase. So let's go to the next topic, which is our topic about how we said the market psychology can often certainly work against you today. And the reason that's true is because the market psychology often lags the economic indicators. So our economy has gone, as you all know, down this slippery slope. Now we're starting to get up the curve here. The economy is starting to improve. We're starting to see more deals. We're starting to see employment improve. Obviously, we have a long way to go, but we're starting to see that improvement. What we're seeing in the marketplace today is that the buyer psychology has lagged what's actually happening in the marketplace. As a result of that, we have this interface area here, which is shaded right here. And the point of that is that not all deals in the marketplace today are distressed deals. I think we've got the psychology of the market, of the buyers, saying, boy, if I can't get it for half off, or if I can't get it for 60% off, I'm not interested. Certainly there are a lot of deals out there that are distressed right now. A distressed deal creates its own problems and creates its own set of risk. But our point is there are a lot of good businesses in the marketplace today that have weathered the economic storm, that continue to generate great revenue and profitability. Those businesses are not going to be priced as distressed sales. So when you see a good business in today's marketplace that has been priced correctly to reflect where it is in the marketplace and the fact that it is cash flowing and profitable, don't expect to try and steal that business. It's going to take a while for the buyer psychology to catch up and meet the economic line, and we're in this phase right now where there is a lag between expectations and reality for some businesses. What I'd like to do is hand this over to Boaz, who's going to talk to us about risk. Boaz?
Thank you, Carl. There are two different approaches to risk. The first is, let's avoid it altogether. What will come, will come. The second one is try to assess the risks and build a mitigation plan for each type of risk. There are risks that are associated with what you do and risks that are associated with what you don't. The first thing that you want to do in terms of risk avoidance is define your criteria. Carl went over it quite a bit. You don't do that, you might end up with a business that you really should not be running, managing, and literally owning. You need to develop your own projections. Oftentimes you look at the financials last 3 years that the current owner present to you, and based on that, you look at his future and you say, guy's experience, he seems to be very modest in his growth plans, if any, might be just steady state, and that's how you look at things, which is wrong, because you have to build your own projection, since during the change, lots of things happen. Competition steps in, try to take some market share from you, even in relatively simple businesses like flower shop or a car wash. The other businesses in the neighborhood drop their prices every time a business, or many times when a business changes hands. When you look at the financials, you want to look at them and do a sensitivity analysis that it is at least 50% more and 50% less than the current sort of likely case scenario to happen. And that ensures that, number one, you budget enough for growth. Number two, you can still afford the business for a downturn when it goes down 50%. And of course, you want to take multiple valuation approaches so you can verify that the business is worth whatever you came up with more than one approach. You can look at multiple that everybody talks about all the time. You can look at return on your investment, and you can look at other things. You should be looking at as many as you can. There are things that you should not do. Don't do it alone. Even if you ran a business before, transitioning from one business to another, taking over from an established business, something that requires a lot of know-how, whether it's taxation, that you can save a lot of money by structuring it up front and making some of your income becoming a capital gain as opposed to wages, or other aspects of it. Certainly in the marketing, certainly in the legal side, you want to make sure that you cover that. Don't believe. Whatever you see, whatever you hear, don't believe it. Find another source or another way to verify the data. Don't fall in love. You fall in love, you close all your common sense, and you just push forward as hard as possible to get close to your loved one. This is not a good way to start a business. Don't underestimate the cost of transfer and the transfer risks. As I mentioned earlier, oftentimes competition steps in, there is a change, location that was HubSpot for the community is changing hands, and this is the opportunity to open a competition to it because the old love has just left the field. And with that, I want to go back to Carl for conclusion.
Okay, well, thanks, Boaz. We are at 1:30, so we are done. The Webbit Rabbit has delivered on time. Before we start the Q&A, and Linda, I'm going to unmute your microphone here as you look at any questions that may have come in. All participants for this webcast will receive our Selling a Business Preparedness Evaluation Guide. It's a document designed to step you through some of the key decisions and things to think about as selling a business. Afterwards, we're going to send a quick survey to you via SurveyMonkey. It's about 5 short questions. If you could answer those, we're always looking to improve our performance on these webcasts. If you do that, we'll give you a copy of today's PowerPoint. We'll also be sending this up to our YouTube channel within about 24 hours or so. So we'd like to open this up for questions now. As we do that, on screen here we've got various ways to allow you to contact us depending on your preference of whether you want to stay in touch with us with Facebook or LinkedIn or Google Plus or Twitter. We're constantly sending information out about additional deals that we've done, as well as upcoming webcasts. We'll have a webcast coming up next month in March as well. So Linda, let's open this up. Do we have any questions that have come in from our participants?
Yes, Carl, we have one question. How much can I rely on my intermediary during the negotiating process?
That is actually an excellent question because it depends on a couple of things. Primarily, it depends on the type of, whether or not your intermediary is licensed, what state he or she is licensed in. If it's a FINRA person, that person is going to be nationally licensed. If it's a real estate person, that person is going to be licensed by state. But the reason it depends on the state licensing is because different states take different approaches to how they license intermediaries. So, for example, in the state of Florida, an intermediary is licensed as a transaction broker. He or she represents the transaction and does not have full fiduciary responsibility to either the buyer or the seller. That type of full fiduciary responsibility or relationship can be created, but as everyone starts out, working with an intermediary who is licensed in the state of Florida, it's going to be a transaction broker relationships. In other states, let's take Pennsylvania, for example. If you are a business broker, you must represent either one side or the other. You cannot represent both. So it varies state by state, and obviously it also varies depending on how much experience your intermediary has in previous deals and operationally working with M&A transactions like this. Linda, do we have any other questions?
Carl, there was another question. How long does it take to complete the planning stage when you want to buy a business?
Gosh, that's a good question as well. Boaz, do you want to answer that one?
No. It really depends. You know, if you are a physician that own the 2 businesses in Chicago and you move to Texas, you probably have it all in your head and you can do it on the flight, and then you just spend a day or 2 with a lawyer and a CPA, and by the end of that week, you will have a pretty good written and solid plan. The alternative is that you are moving into a market you don't know, and say you've been in retail all your life and you want to move and do, instead of open to the public brick and mortar location, you want to do an e-commerce business. Well, now you need to learn a whole different terminology. Instead of how many customers came in the door and what is the income per square feet, you need to start talking about cart abandonment rate and SEO optimization, search engine optimization, and things that are ununderstandable, easily picked up, but it takes time for you to develop the know-how, and it can linger into weeks, sometimes months, and that delays your ability to put together a whole plan for a new business. So really depends how familiar you are with the market, with a new geography, if you are moving from one place to another, and with the specific customer base that you are going to try and attract.
I also think, let's go to our whiteboard here. I also think it depends on the size of the company. If you're doing a corporate acquisition and you're looking at a a large business that you're going to be buying with lots of real estate in New York City or wherever it is, obviously that is going to require a lot more resources than if you're buying an internet business that is all online and all global versus a local regional business that's maybe a local manufacturing company that only produces products for a local area. So you have to scale the expectation and the planning to some of the things we talked about earlier in the presentation, which is your goals for the acquisition, what size company that you think you want to acquire, and what you want to accomplish as part of the entire process, and then who your team's going to be. So lots of things to think about. Again, the planning process doesn't have to be a 100-page document, but it's important that when you walk into this situation, you understand and you have thought about what your goals and objectives are and what your resources are and how you're going to allocate those. Boaz?
Time is always of an essence, and while you don't have, like in a school situation or a course, a given end date and a test, the test you should put is when do you feel that the acquisition plan, the buying plan is mature enough, in your opinion, and in some of your advisors' opinion, that you can move on and take it forward. You should not consider the fact that you have a partial plan a stop as well. You develop the plan and you improve on it as time goes by and your level of education and know-how in that specific space goes up. But you don't make the decision to purchase before you have a clear plan and 90% or so, the major 80% of the issues have been resolved and the rest is left for the due diligence.
Great. Linda, any other questions?
Carl, we have one last question. If I'm going to buy a business, do I need to have the financing already arranged, or do I wait until after I found the business?
Gosh, that's another great question. and that has multiple answers. Let's go to the whiteboard again. If we have a timeline here where time is going this way, and let's say this is your closing date, so we'll put a big C there for closing, and let's say this is when you start the process. I think if you have done a planning phase, let's call this P for planning here, and let's kind of shade this yellow. If you have done a planning phase and you know a lot of the answers to the questions about what this deal is going to look like when you get here, in other words, we know what size company it's going to be. We know it's going to be an e-commerce company. We know it's going to be in the range of X to Y in terms of revenue and EBITDA. Then I definitely think that along this phase here, somewhere you are thinking about and starting to have preliminary conversations with your banking team, with your maybe shareholders and your investors, to let them know what's going on and what's coming, so that when you get to this point, it's not a total surprise and you don't have to start from scratch. If you had to start from scratch from this point, before you get to the closing here, you're now, let's say we have a deal right at this stage. So you're now saying to the selling company, hold on a minute, because I need some time between now and closing to go to talk to all of my people. So I think it's a question of anticipating in advance what your plans are, cluing your investment team, your stockholders, shareholders, and bankers into what you're thinking about doing. They're going to want to look at your financials in advance to the extent you can have all of that pre-packaged and pre-communicated. By the time you get to this closing down here, you're going to save an enormous amount of time. What you're not going to know are necessarily the specifics of how this particular closing is going to look. There are going to be some variations on the theme when you get to this date, but if you've done the planning work leading up to it, it's not a surprise, and you've saved yourself a lot of time and energy and probably money as well. Linda, anything else?
No, that was the last question, Paul.
Great. Well, those were all great questions. We thank you again for your interest in Navigate. We know that you're busy during the day. We appreciate your time for participating. We'll be sending you our questionnaire. It will only take you about 2 or 3 minutes, if that much. So thank you very much for considering giving us some great feedback. We look forward to having you join us the next time around. Have a great day, and we'll talk to you soon.